Hi everyone, thank you so much for joining us here on this video today. So today I wanted to make a quick video on bid-ask spreads when trading stocks and options. If this is your very first time here, thank you so much for joining us on this video. My name is Kirk with Tactical Options Trading, and we make videos just like this on a consistent basis where we talk about the stock market and options trading. If you'd like to learn more, consider subscribing and clicking that bell so that you don't miss out on any future videos. Alright, you guys, let's just jump right in. So we're talking about bid-ask spreads. Well, what is the bid-ask spread? Well, let's talk about that. So the bid price is the price that the market is willing to buy from me. So if I had a stock or an option that I wanted to sell, I would put that out there on the market, and we'd have buyers come in that are willing to buy at a certain amount. Well, the price that they're willing to buy from me for is the bid price. You could think of it as an auction, so to speak. You know, you got people that are bidding on certain items at the auction. Well, in this case, they're bidding on that stock. So they're willing to pay this amount, and that would be the bid price. So as the seller, I'm going to sell that stock to them at that bid price. Now, the ask price is the price that the market is willing to sell to me for. So again, if I'm the seller in this case, there's a certain amount that I would like to get out of this this stock or this option, and that would be the ask price. So I'm going to put this stock or this option out there on the market, and I'm going to ask a certain amount for that stock or that option, and that would be the ask price. So as a buyer, if I was to buy in the market, I'm going to buy at that ask price. Now, we know that there's going to be a difference between what the seller is willing to sell that stock or that option for and what the buyer is willing to buy that stock or that option for. And that difference is the spread. So that is what we call the bid-ask spread. So let's take a look at some examples of some bid-ask spreads. And I want to hopefully in this video show you guys why it's so important to trade stocks that have narrow bid-ask spreads versus wide bid-ask spreads. So let's take a look at an example of a wider bid-ask spread to see why we want to trade a narrow bid-ask spread. So right now we're going to be looking at a wide bid-ask spread, and we're looking at a spread that's $1 by $1.50. Now we're looking at option contracts here. Now let's say we wanted to buy an option and that option cost $1.50, and now we know that we're going to be buying at the ask price. Now remember, anytime we buy a stock or we buy an option, to theoretically close that option or close that trade, we're going to have to sell that option. So you can see in this example right now, if we're buying at the ask and selling at the bid, we're already going to be down $50 in this trade because we have that big spread there. So if we bought it at $1.50, we know that in order for us to be profitable, at least on this trade, that we're going to have to be able to sell it at $1.50. But in this case, looking at the bid, we have to sell it at that bid price. So the difference between the $1.50 and the dollar is 50 cents. Now when we're trading an option contract, that option contract controls 100 shares of the underlying stock. So in this example, we would be down $50 already right off the get-go before the stock even moved or did anything. So what I'm saying is we want to trade a narrow bid-ask spread because in this case, that option is going to have to gain at least 50 cents in value for us to even break even on this trade because of that wide bid-ask spread. Now let's take a look at a narrow bid-ask spread, and we can see what the difference is there and why it's so much better to trade a narrow bid-ask spread. So example here, excuse me. Example here again, we're going to be buying at the ask price of $1.01, and then the bid price is what we're going to be selling it for. So you can see in this example, we are only 1 cent difference here. So in a one option contract, that would represent $1. So the option in this case would not have to gain that much value in order for us to even break even on this trade. In fact, it would only have to gain 1 cent in order for us to be at that ask price, in order for us to break even or at least hit that ask price or break even ask price. So let's take a look at some actual examples in the marketplace, looking at some options chains. And I wanted to show you guys an options chain of Cisco. Now Cisco is a pretty well known company. It does trade a lot of shares. You can see that we've traded 9 million shares on Cisco already. And when we look at the options chain, you can see that we have quite a bit of open interest here in these different option strike prices. Now let me just take myself off the screen here so that you can see this whole screen. And you can see over here on the left hand side we have the open interest column, and you can see that we have lots of open interest at these different strike prices: 24,000, 14,000, 16,000, 9,000. Same thing over here on the put side. We have a lot of open interest. Now the neat thing is the more open interest that we have, the actual the bid-ask spread is more narrow because there's a lot of liquidity in those options. A lot of liquidity, a lot of buyers, a lot of sellers. So you can see here on Cisco, looking at this $48 strike price, you can see that the bid and the ask is just a couple of pennies wide. So we can buy it at 109 and we could sell it at 107. Now let's say, for example, we roll out here a little bit to some farther away options. You can see that that bid ask gets a little bit wider. Example, at this $26 strike, you can see that the bid ask is about $4 wide. We're looking at 21 for the bid and 25 for the ask. Now again, let's say, for example, we bought this option. Not that I would, and I'm not recommending that, but if we bought this this $26 strike for $25, when I click that, it opens it up down here in this window, and you can see that we can negotiate that just a little bit. So where does these numbers come from? So what I want to show you guys here is where do these numbers right here come from? So if we come in here and we click that $26 strike again, you can see that that natural price is $25.05, and $25.05 is right here. So that would be the natural price that we could actually buy that stock for, or buy that option for, at $25.05, because we're paying the seller exactly what he wants. We're paying him the full amount that he's asking. But remember, we can negotiate this a little bit. Now, what is this mid price right here? Well, this mid price is basically the difference between the bid of $21 and the ask of $25. So the mid price of that would be the difference of these two. It's $23.025, and you can see that that is right there, $23.05. So that would be the mid price. So basically, we can negotiate that down somewhere between the mid price and the natural price. So if we come in here and we click this little plus and minus here, you can see that we can negotiate that bid-ask spread just a little bit. Now, the important thing to understand when we're negotiating the bid-ask spread is, that could really make up a lot of difference when we're trading, because we can negotiate that when we buy that option, and we can also negotiate that when we sell that option. So if we negotiated $50 on the buy side, and then $50 when we close it, we just saved ourselves $100 on that trade. But if we're trading stocks that have a lot of liquidity, then we don't have to worry about that big bid-ask spread. So what makes stocks have big bid-ask spreads? Well, we already talked about one, which is liquidity. And when we have liquidity, we have a lot of buyers and sellers in the market. So we have a lot of people that are willing to buy, we have a lot of people that are willing to sell, and it makes up a nice difference there of a lot of stock, a lot of options changing hands, so we don't have that big gap. But options with low volumes usually have wider spreads. We know that, and we can see that just by looking at that Cisco there. Now, large bid-ask spreads on illiquid shares are also used by market makers to compensate themselves for assuming the risk of holding low volume securities. So when we're talking about market makers, what do I mean by that? Well, let's talk about that just for a second. So, market makers have a duty to engage in trading to ensure efficiently functioning markets for securities. A wide spread represents a higher premium for market makers. So what does that really mean? Well, a market maker is like a bank, or they work as a broker basically, and they stand ready every second of the trading day with a firm bid-ask spread. So this is good for you because let's say, for example, you had 1,000 shares of Microsoft stock that you wanted to sell to the market. Well, if we didn't have a market maker there, you would actually have to wait for a buyer who was willing to buy those 100 or those 1,000 shares of Microsoft stock, and you might be waiting as a seller for a long time. Well, that's when the market maker steps in and they actually say, hey, I might not have the buyers yet, but I'll go ahead and buy that 1,000 shares of Microsoft stock from you, and I'll hold that until I can find a buyer. Now, that market maker is going to put a spread in there because they got to protect themselves. Because what if they took those 1,000 shares of Microsoft stock from you, and then the market actually dropped, and they ended up holding these shares, and they had to sell those shares at a little bit different or a little bit less of a value because from what they bought it for, while they're trying to find that buyer. So, market makers actually make a market by, putting that out there, what they're willing to sell it for, what they're willing to buy it for, and they put those buyers and sellers together, and then they put that little bit of a spread in there. So on illiquid stocks, that spread will be a little bit wider in order to protect themselves because of, just to give themselves some room on that trade. So volatility also has an effect on market pricing as well. So as the option volatility or the market volatility increases, the bid-ask spread on certain options or stocks is also going to increase as well. So usually investors and market makers are going to try to take advantage of volatile markets. And you can also think that, on these outlying option strike prices, as the market moves and it moves in a very fast movement or an abrupt movement, there may not be a lot of open interest there or a lot of liquidity at those different option prices. So the market maker is going to step in there and they're going to have to protect themselves. And so they're going to make those bid-ask spreads a little bit wider. So I hope this video has been helpful in helping you understand why it's important to trade small or narrow bid-ask spreads. If it has, I hope you'll give it a thumbs up and a like. If you know anybody that might be benefit from this video, I hope you'll share it with them. And again, consider subscribing. We love making videos like this on a consistent basis. My name is Kirk with Tactical Options Trading. Thank you again so much for joining us. Have a good one, everybody. Talk to you later.